So I'm going to talk about the real estate sector, but we've been following on from some very, very interesting individual companies. And the theme that I'm going to have when the slides come up, please, would be to invest in individual companies rather than a sector. As I say, it is a talk about property and the real estate sector, but that very much the focus is going to be on we should be looking at individual stocks because I don't think that we're quite yet at an inflection point for the whole UK sector that means you've got to buy fairly indiscriminately. The REIT sector is going to sort of shoot up straight on from here. This is really following on from a couple of Hardman Forum presentations that I made earlier this year that was looking at a sector where, yes, the volatility of rents and the volatility of asset values and interest rates were all coming down, which is a really good sort of starting point to build value, but that there still wasn't really enough skin in the game, as it were, to go overboard. And I was taking a reasonably negative view, even though, when interest rates turn, that might be seen as a time to pile into real estate. So I'm thinking that that base is forming, but that it's too early to yet be indiscriminate, and we've got to look at some very specific situations rather than across the board. Just to put the UK in context, I mean, nearly 90% of REITs globally are quoted in the US. US prices, as we'll see in a second, have actually gone up a bit this year, not massively, whereas UK REITs have gone down. I'd also say that we're looking at a sector rather than specifically REITs, and real estate is run as a real asset, that's the equity, with a long-term view on rents that are backed by real assets, but it also runs on debt. And this can be a friend, a false friend. It can also be a way to invest in real estate. And this shows us in the US how, as I say, that's 90% of the global market nearly. The largest REITs are very different to the large REITs that you've got in the UK. The largest one is a well-known logistics company, but an awful lot of American REITs are actually communications digital infrastructure. American Tower is the second biggest REIT, and the clues in the name. So if you look at the global market, it is fairly dominated by a very different sort of asset to the UK. The UK is a little bit more old-fashioned, looking at offices, retail, industrial assets, and so forth. So I just want to put that in context of looking at the global market. A way to invest in communications is the largest market, which is the US. And we are comparing the US market here and how it's starting. If you look, there's quite a few years of transaction, or rather sort of index history, and the S&P share sector has risen about 9% this year. If you look at the figures, we've got one figure at the end of 2023, and the current year is, as I say, up 9%. But this is driven actually primarily by those communications REITs. So even though we're seeing a US market as a whole for equities that's very buoyant, and we're seeing a REITs market that is starting to slightly rise. If you turn to the next slide and look at the UK market, again, that underperformance of US REITs versus the US market, you've got more underperformance in the UK. So the UK, this is a rather busy slide, and we're looking at the UK market share price of the REITs sector compared to its NAV. So it is a very busy slide, but if you look at the last year in particular, it has been derated further. So this is the share price relative to the NAV. With NAVs falling, share prices have fallen even further. We can see that translated into the index. This is going over the past sort of 7 years or so, but the past year has again seen falls in the sector and in the main share prices. So why is that? If we're seeing a situation where you've got a much steadier situation for rents starting to grow even in retail and where interest rates are falling. So I think that where we're at is the re-rating is awaiting a real change in interest rates. Because if we remember back from what Richard was saying earlier on, the bulk of acquisitions were made at around about 5.5%, 6% net initial yield. A lot of REITs geared up to get a sense, what they saw as a sensible return from that 5% with borrowing money at 2% or whatever, and then getting a total return that was seen as acceptable. Certain REITs that are buying at higher net initial yields didn't have to gear up as much. So that's great news for them, but not such great news for the sector, particularly as the gearing up has meant that the debt lines have started to mature. The REITs have started to have to re-gear themselves with new debt lines, sell things off, find themselves with a net income yield after the gearing that's way too low. So I think that it will take more falls in interest rates to start to have a real impact on the overall UK REIT market. It's more stable. You can start to look at individual situations within that, but having a wider view of let's buy the sector is wrong. So what we need to do is actually look at a wider selection of opportunities. And the derating to NAV, which is sort of fairly across the board, does throw up some very interesting opportunities. We've heard from one earlier on. I mean, Custodian's share price to NAV has been derated over the past several years, and it isn't in a situation where it's overgeared. I'm not here to recommend individual shares. I'm more pointing out that the derating and the start of the change in the interest rate cycle means it's time to start looking at individual situations. The other situation that I mentioned right at the start was that real estate does rely on debt, and that can be a false friend. But there are ways that investors can invest in that debt. Again, as I say, I'm not here to recommend individual stocks, more strategies to look at. And one example is about a 280 million market cap real estate credit investments that invests in debt. So it's effectively a lender to real estate companies, in fact, global real estate companies. There, you've got a situation where the rise in interest rates that's taken place means that they've got scope to, when they are reinvesting in their debt as it matures, to actually get a higher rate of return. So that the general rise in interest rates has helped these debt investors. There's lots of details that we can't go into now, but I think it's a point to bear in mind that it's not just REITs that are a way to invest in real estate. There are lots of broader ways to deploy cash. I think that the point to sum up is that we have made a couple of presentations earlier this year where we're saying that it's probably not yet time then to look at REITs very, very actively. We're thinking that now, with the volatility reducing a lot in terms of interest rates, in terms of asset valuations, and with rents starting to go up, it is time to start looking, but that we don't see an across the board massive rise in valuation. We see individual situations, those situations that are not too highly geared, that are investing in assets that generate good income, or looking at the flip side, investing in debt. Those are the sort of areas that we're starting to see real interest. Thanks very much.